Yes. So we learned about various charging mechanisms, right? There were a lot of charging mechanisms that were discussed in the last few classes. One was IIR, and then there was UTPR, and then there is QDMTT. We know how it is calculated, right? What are the charging mechanisms? IAR is collected by UPE, UTPR is collected by other constituent entities which have a qualified UTPR status, and QDMTT is collected by the jurisdiction of the low tax constituent entity. Now, what we are going to do in this chapter is not something new, but to discuss how these three charging mechanisms interact so that we don't have any, we are checking all the boxes and all the queries which have with respect to interaction. Okay, so the whole purpose is you will be able to apply the correct sequence of globe rules, determine which rule collects top up tax in a given scenario, and coordinate multiple rules to avoid double taxation. So we have studied all three in silos till now. Now we'll combine everything and see how it works. Okay. So this is the whole purpose. Now, yeah, again, there are three charging mechanisms: QDMTT, IIR, and UTPR. You have to understand that the ordering rules represent a carefully negotiated compromise among 140 plus jurisdictions in inclusive framework. Balancing source countries decide to retain taxing rights, parent countries claim to include the subsidiary income and need for backstop that ensure no low tax profits escapes entirely. This chapter maps the complete interaction. See, if you take the jurisdictions of an M&E group, if there is any tax that is coming from the constituent entity, the jurisdiction of that constituent entity would like to charge, right? The holding company, the parent entity would also like to charge because we are having substantial control. And in midst of all these, there would be taxes which is lost also. That is why we have three charging mechanisms. Let's understand how they interact. Okay. Now, fundamentally, one point so that we are on the same page, all these rules apply to constituent entities defined in chapter 1.2. Okay, in chapter 1.4, we spoke about excluded entities, correct? So these are not subject to globe calculations, and therefore no top-up tax arises from them under any of these three rules. So these three won't apply to excluded entities. These are all constituent entities which are not excluded entities. Okay. Now, with that background, let's understand the three-layer rule order. Okay, so globe framework operates through a strict priority sequence. There is always a sequence. Understanding this order is essential, and applying rules of the out of the sequence leads to incorrect calculation. So you have to always follow the sequence. Now, what is the sequence? First priority is always given to QDMTT. Okay, whenever there is a top-up tax in that jurisdiction, the domestic tax is not 15% or the effective tax rate is not 15%. The first priority goes to QDMTT. Okay, if that particular jurisdiction has introduced a QDMTT, then that first priority is there. After QDMTT is applied, if anything is residual still, then only IIR comes into the picture and parent entity collects it. And after obligation of IIR, if anything is again residual due to the inclusion ratio problem, then UTPR kicks in. So it's always in this priority. Now, people may say UTPR would be very rare in that scenario. Certain circumstances it will come, but the thing is, you have to always follow this priority. The first charge is always to the source country, then the parent entity, and if there are still taxes which is not then it goes to the constituent entities. Okay, so each rule applies only to the residual top-up tax not collected by the higher priority rule. Now, why is such a priority? Because it reflects both economic logic and political reality. QDMTT's first position honors the principle that source jurisdiction should have the first opportunity to tax income arising within their borders, even if that income was previously undertaxed due to domestic incentive regimes. That this also created a powerful incentive to low tax jurisdictions to implement their own QDMTT, right? Because let's say that if a country does not have a QDMTT, definitely the parent entity's jurisdiction would get the 100% of top-up taxes to be charged. So, see, why should they let go of a revenue which they could easily have? So that's why most of the countries would come in QDM, would bring in QDMTT, and this priority sequence makes it a good incentive for them to, for in all jurisdictions, to bring a QDM. Now UAE only has a QDMTT. It does not have a qualified IIR status, neither does have a qualified UTPR status. So the only thing that with respect to pillar 2 that would apply to UAE is QDMTT. And if there is any spillover, if MNE is having a regional presence in UAE, and if it is spillover, then only their parent entity can charge. Are you understanding this? Like the priority sequence and how it goes? Because I felt that these were not very clear from yesterday. So let's take a point of addressing the interaction. Now let's talk about each layers in detail. What is QDMTT? QDMTT is nothing but a domestic tax law. It is a domestic tax law, and in UAE it is Federal Degree Law number 60 of 2024, I believe, that imposes top-up tax in the low tax jurisdiction itself using globe consistent rule. So how you will calculate the globe income and how will you calculate the top-up tax is going to be similar to the entire picture that we will study in chapter 3 and 4, like from next week, how to determine this profit. Now all this while we were talking about top up tax, right? How to determine the top up tax is something that we'll go study in the next class, not next class, next week. But end of the day, QDMTT is a domestic charge, right? And QDMTT has priority. Why do you think QDMTT has priority? Because it is the source jurisdiction. The profits are arising from that jurisdiction. So it is pretty obvious that it has to be given priority, right? So QDMTT preserves the source jurisdiction's taxing right. Rather than allowing other jurisdictions to collect top-up tax through IAR or UTPR, the low tax jurisdiction can collect it domestically. Fantastic. Now there is something called QDMTT offset also. Nothing but, like, if when a jurisdiction has a qualified QDMTT, top up tax collected under QDMTT reduces the amount subjected to IIR and UTPR. So while you are calculating IIR, you have to deduct or reduce the top up taxes which is collected by QDMTT. Okay. So residual top-up tax which will go for IAR calculation is jurisdictional top-up tax minus QDMTT already paid. Okay, this is going to be the residual top-up tax which is used for IAR, allocation. And after IAR, so in UTP, when it comes to UTPR, the residual top-up tax is going to be jurisdictional top-up tax minus QDMTT paid minus that paid by the UP through IAR. Correct? Getting it? Now, IAR, you know IAR already. When does IAR apply? IAR apply when it is, where after QDMTT, IAR applies to any residual top tax. IAR is collected at the parent entity level using top-down approach from chapter 2.1. So it's always going to be top-down. Okay, first you have to see the UPE has a qualified IAR status. If not, then it goes to the IP. So it's a top-down approach. Basically, top-down approach is nothing but if UP jurisdiction has a qualified IAR, then there is UP will collect. If UP does not have a qualified IAR status, then the IPEs will step in. But either case, even if UPE has a qualified IAR, if the entity is a POP, now what is a POP? It has ownership interest in another entity, in another constituent entity, and it itself has more than 20% of external shareholders. In such a situation, it becomes a POP, and POP would apply IAR separately, and whatever is the top-up tax paid by POP will be used as an offset by the UPE at the time of calculating its IAR. These things are already clear from the last classes, right? Okay. Now there is this is basically the IAR offset mechanism. Nothing but if UP and POP are both applying, then IAR offset prevents double taxation. These are all things that we went through. And always while taking the offset, please understand the higher tier parent reduces its allocable share by the amount charged by the lower tier entity. So it's always higher tier entity which would be giving the offset, not the lower tier entity. This guy will pay, this guy will offset. Okay. Now UTPR, you know what is UTPR? When UTPR applies, it's just a backstop mechanism. It applies when there is residual top-up taxes after QDMTT and IAR does not fully collect the residual. Okay, because of minority interest, because there is no qualified IAR at the UP or IP level, then UTPR kicks in. So you when the, so just few scenarios. UP jurisdiction has no qualified IAR. IAR cannot apply at the UP, and no IPE with if there is no IPE with the qualified status in the chain, then absolutely UTPR is the backstop. There is no IAR at all. The complete residual taxes after QDMTT goes to IAR. Also, it applies when there are split ownerships. Okay, IAR may apply. The UP may be in a qualified IAR status, but it has significant minority interest. Then that minority interest portion would be collected by UTP. I think these things are all clear from last time, right? So that's why we are running through. If UP's own jurisdiction is low taxed, IAR would apply the UP's jurisdiction not. So, and then I told you there is a transitional UTPR safe harbor also. That is years beginning before 31st December and not ending later than 31st December 2026. There won't be any UTPR at the UPE's jurisdiction. So if there are constituent entities in the UP jurisdiction, and if the UP's jurisdiction has a corporate tax rate, not an effective tax rate, the total corporate tax rate of around 20%, then it comes under the safe harbor for such a small time. Okay, it's just a transitional UTPR safe harbor. Now, if you understood all these things, then let's kind of as an exercise fill this, and I will not be filling this, you guys would be filling this. So what I'm going to do is I'm just going to copy this table and yes, yes. So basically what it is about is that in such scenarios you have to tell me which charging mechanism would apply. Okay, yes. Now what is this? So is there a QDMTT? Okay, we are thinking of possible scenarios. These are the only scenarios which could come out. Okay, so there is QDMTT in LTC's jurisdiction. Okay, and QDMTT gives full coverage, and there is a qualified IAR also, and there is 100% ownership also. Which charging mechanism would kick in? There is a QDMTT which has full coverage. That means whatever is lesser, it tops up the tax. QDMTT tops up till 15%, full coverage. And there is a qualified IAR at UP, IP stages, and also it has 100% ownership, no minority interest. So which rule will apply? Which rule will only apply? Yes, Sahil says it's only QDMTT. So let's write down only QDMTT. That's fantastic. Now let's do this. QDMTT is there, but it is only partial. And there is a qualified IAR. And also the ownership is 100%. Which charging mechanisms would arise in this situation? There is a QDMTT, but QDMTT is only partial. And UP is in a qualified IAR status. Now tell me, Melvin says QDMTT and IAR. Perfect, Melvin. So QDMTT and IAR will apply. Fantastic. Now let's take third option. QDMTT is there, but again it's partial. Qualified IAR status is there, but 100% ownership is not there. Now what will happen? What all charging mechanisms could kick in? Yes. There is a partial QDMTT, there is a qualified IAR status, but there are minority interests. Then, yes, no response. Okay, so there is a partial, partial QDMTT. So definitely QDMTT would be there, right? Then qualified IIR is there at the UP level, but UP has minority interest. So that means only 80% of inclusion ratio would be collected. I mean, the IIR would be collected only up to the inclusion ratio. Inclusion ratio is not 100%, right? So even though IIR is there, it does not calculate 100%. So there would be residual top-up taxes after IIR, and hence UTPR will also be there. Are you understanding this? It's pretty straightforward. It's a scenario, right? Let's do next one. So you tell me next one. So there is a partial QDMTT in partial QDMTT, and there is no qualified IAR status at UP or IP level, and there is 100% ownership. Now, which charging mechanisms would kick in? Yes. Yes. See, there is a QDMTT that is there in the jurisdiction. So definitely QDMTT would apply, right? Since it gets the first priority. But the thing is, it's only partial. So there is going to be residual top-up taxes. Now, what is the second priority for collecting residual top-up taxes? IAR. But the question says there is no IAR at UP or IP levels. No IAR at all. So what happens? And let's assume there is no POP. So what happens? There is no IAR, and even though it has 100% ownership, since there is the residual taxes are not collected as IAR, the entire thing goes as UP, right? Now let's do next one. You tell me next one. Why are you not telling the, I mean, why are you not participating in the last two options? Now you have to tell me. You always have QDMTT and UTPR. Okay, fantastic. Now, okay, there is a question. UTPR qualification is different from IAR qualification. Absolutely, Melvin. So, just because it has a IAR is only for UPs and IPs, correct? It's a top-down approach. So, you have to see if these UPs and IPs have qualified IIR status. UTPR is perfectly different. UTPR actually, for you have to see if those other constituent entities which are not UPIP, they have a qualified UTPR status. Then only they can share in the pool. Okay, is this clear? So for application of IIR, we have to see if UPIP. For application of UTPR, we have to see if the other constituent entities have a qualified UTPR status. Okay. Now tell me, is that clear? Okay. Now you tell me the next one. I saw Ashik raising hands. Is it a typo or is it a question? Okay. I'll just wait till his question comes in. Me? Okay. I started receiving answers for the next one. Okay. Let's see, Sahil. QDMTT is not there. Okay. Let's look at the scenario. QDMTT is not there. Okay. There is a qualified IAR status and there is 100% ownership. So what will come? Absolutely, you're right, Sahil. There will only be IAR because 100% of the top-up taxes, will not be collected through QDMTT. 100% of the top-up taxes would be residual taxes. And since there is 100% ownership and since the inclusion ratio would include everything, then there will be IAR only. Perfect. Fantastic. Now let's do this one, next one. There is no QDMTT in LTC's location, but there is a qualified IAR and there is no 100% ownership. Then there would be IAR and UTPR. Absolutely. I think somebody, Sahil is aging it, then there would be IAR and UTPR. Now, with respect to last one, let's do that and then take Ashik's question. So there is no QDMTT there is no IAR also, then it becomes very obvious it is 100% of the top of taxes for that LTC will be collected by UTPR. I think I already see, yeah, UTPR only. So you see different, scenarios where different charging mechanisms kick in. End of the day, the whole objective is that no taxes go away. Did you understand this table? Is this table clear? Now let's take Ashik's question. Now his question was, in case if that parent entity, I think you were talking about scenario, okay. In case if that parent entity has more than 20% corporate tax, then they may get safe harbor, right? Meaning UTPR won't be applicable. My dear, UTPR won't be applicable in the UPE's jurisdiction if you have safe harbor, not on others. Okay, so let's say that, for example, let's say there is this is the UK company is the UPE. Just next it. Okay, UK company is the UPE, and then I have another company in, you know, I have a German company, I have a Switzerland company, I have an Ireland, and I have a Netherlands. Okay. Now, this German company under it has another company, let's say in Korea and Japan. Or let's say it has in Korea. Now, let's say this is an LTC. Okay. At the same time, this Netherlands has a constituent entity in UK. It has a subsidiary in UK. And this is also an LTC, right? Now, normally what happens is if IAR is not collected and for this LTC alone, UTPR will not be applicable for this LTC while calculating it is. Why this will not be applying for the transitional period is because it is in the UP's jurisdiction and it has a more than 20%, but doesn't exonerate others. You understand? So it's not that a blanket UTPR will not apply for that period. It's just that it won't apply for the UP's jurisdiction. Now, in this instant, the UP might also be a low tax jurisdiction, correct? I mean, it could happen that it could also be a low tax constituent entity. It's not paying 15% tax. So in such a scenario also, like, these things won't apply in the first year, right? Because they are just bridging it. They are making returns and they are making things for that. So right now it is not there for the transitional period. It would in from after the transitional period is over. But this definitely this would have to pay because it's not in the UP's jurisdiction. Okay. Is table is clear how the rules interact? How can QDMTT be partial? Now, Sahil, let's say that the charging mechanism in the domestic entity is such that you are not able to collect 100%, 15% ETI. Now, for example, let's say that we have a tax rate of 9%, right? Now, the rules are drafted domestically in such a way that now your new tax is 15%. I mean, for if you are a constituent entity of a large M&E group, then your tax charge is 15% after 375,000. Okay, they keep the minimum limit in the QDMTT rules as well. Then what happens is, does it result in effective ETR of more than 50, effective ETR of 15%? Yes or no? Then it is partial again, right? For others, we have to do like, so it could happen. See, I'm not saying that it would always happen, but in case if it is partial, because the rules are like that, we don't want you to pay so much of taxes. Let the head office pay, the UAE entity will not pay any taxes. These rules could come out. So if it is partial, then only it will trickle down. If it is not partial, if it is fully covered, yes. Okay. Fantastic. So I think you understood the interaction metrics. Now let's move on. Let's do interaction metrics, all rules combined question. Okay. So let's say AR owns 70% of a subsidiary in country Z. Country Z has no QDMTT Top up tax is 1 million. Details of other CEs and UTPR percentages are provided. Now, how do you do this question? You tell me. I'll just open one more sheet. What is step one? Step one is what is the top up taxes? Or let's not do, let's kind of like, okay, let's do this one. What is the top up taxes? For top up taxes for countries. What is the top up taxes? What is the top up tax? They have given it as 1 million is the top up tax. Okay, it is the top up tax, not their effective tax. So you have already calculated top up tax. If they have given the effective tax or any other tax, then you have to see what is the percentage of that, and top up tax is only that which is less than 15%. Okay. So top up tax is 1 million. Now, first priority is what? Correct? First priority is QDMTT. Is there a QDMTT? There is no QDMTT. Okay. So what would be the QDMTT charge? Nil. Let's say 0 here. And what is the residual taxes? Sorry for that. What is the residual tax after QDMTT? It's going to be this minus this, right? The entire thing is residual tax after QDMTT. Now, what is priority two? Priority two is IIR, right? Now, in IIR, it says AR is the UP, correct? AR owns 70% in country Z. So, the inclusion ratio is how much? Inclusion ratio is 70%. So, what is the top IIR collected? It is going to be the residual top up tax into inclusion ratio, right? So, that is going to be how much? This is the residual tax into this. So 700,000 is collected. After that, what is the residual tax? Next residual tax is going to be opening balance minus IAR. So 300,000 is still residual tax after IAR, right? Now we will do UTPR. Now for UTPR, we need what? We need to split this 300,000 in three. So we will take for we have given the UTPR percentages and it is 100%. So first UTPR charge in UK is what? 300,000 into 50%. They are given the UTPR percentages, right? We know how we calculate it, employee factor into tangible asset factor. So first one is into 0.5 will go there. Then they've got Germany, 300,000 into 30%. And what is the last country? France. France is 300,000 into 20%, right? So what is the residual tax after that? This minus this, it is going to be nil. Did you understand? This is how the charging mechanisms will interact with each other. Yes? Are you understanding this? How charging mechanisms will interact with each other? How the charges will go? Hmm? Oh, fantastic. What about Pope here? Fantastic. So right now we have not, there is no details about POPE. But if there is a POPE and POPE is having 100% in subsidiary C, then things will end in IAR itself, right? So there is no there is no specific mention of a POPE anywhere. So if the question has a POPE, definitely POPE, and if the POPE is having 100% ownership, then definitely IAR will stop at POP. But if POP is not having 100% ownership, but let's say 90% ownership, then again UTPR will kick. Okay. This structure can be a POP. I mean, see, I didn't understand that question at all. Right now, there is no POP details which is given. So there is AR owns 70% of a subsidiary. Okay, 30% is by external investors. There is no POP here, and AR has other entities in the group. Okay, if AR is the UPE and AR has another constituent entity holding, 70% or 90% here, then things will change. Right. Here, the UPE directly owns the subsidiary. This is low tax subsidiary in country Z. Getting it? Okay. Fantastic. Now, there is something called switchover rule. Now, this is very important. This is something with respect to international taxation. This is new. And what it basically means is the switchover rule addresses situations where tax treaties may prevent IAR application. So let's have some context as to what is switchover rule. Yes. Okay. Now you tell me, to understand switchover rule, we have to go a little bit, we have to understand a little bit of concept. Now you tell me, you are a entity. Now you are an entity, okay, which is resident in, let's say, Switzerland. Okay. Now let's assume that you have a PE. Okay, you have a PE in France. Okay, so this is a PE. Now I told you that PE is going to be another constituent entity, correct? PE is going to be another constituent entity altogether. Now that means that for this model to work, let's say this is the POPE or IPE or UPE, then he has to collect IAR, like he can collect he has to pay the IAR, right? Now, if let's say if this is an LTCE, this guy pays the IRR, right? If this is an LTCE, I have to pay IRR for this guy. Okay, correct? Yes or no? See, if there is any problem, then we can discuss. I will repeat the question again. So there is an entity in Switzerland. Please listen and please don't, because it becomes very difficult to coordinate. Okay. Uh, let's say that there is an entity in Switzerland. An entity in Switzerland has a PE in France. Okay. And let's assume that this PE is a low tax constituent area. Okay. Now, there is no QDMTT status. Okay. There is no QDMTT. Now, in such a case, it will be IAR, correct? Switzerland has to now pay IAR? Yes or no? Right. So uh, now this is where a problem starts. Now there would be treaties which would prevent it. Now how would they prevent it? I think you would already know this, because let's say that if there is a income of a PE, right? I am given two options with respect to income of a PE, which is income of a PE may be taxed as, I would get a full exemption. So PE location would pay taxes. It would again be taxed here, but treaties may give an exemption or a credit. Do you know? I think you already know all this. They'll give a foreign tax credit. Correct? Yes or no? So the treaties would say is, as if there is any income in respect of PE, some it can be exemption, or you can take up. You can, in UAE corporate tax law actually allows us to choose between whether we want an exemption or whether we want a foreign tax credit. But what happens is, in sometimes some treaties may say it is only exemption. It is only exemption, no credit. Now what will happen? Then you apply IAR legally then? Because the treaty actually says any income with respect to the PE is going to be exempt at the resident country's level. So in such a scenario, IAR mechanism does not work out, right? Because IAR is what, end of the day, it's a low taxed in France. So I am paying the taxes here. So the treaty would word that, okay, some treaties, like say that Swiss French treaty, hypothetically says only exemption method is allowed in case of PE income. Then legally, based on the treaty, some people may kind of like what they say, I don't need to apply an IAR for this PE because I am exempted. I don't need to kind of like, include PE's income into my tax return. Right? This could come, right? You understand the problem with existing treaty framework. So in such a scenario, they have brought in something called the switchover rule. Now, what does this mean? So switchover rule addresses situations where tax treaties may prevent IAR application. So how tax treaties prevent? Because they would say it's only exemption. So once they include the top-up tax income here, it would be exempted. It won't be taxed again. It won't be taxed here. It won't be taxed here, because the IAR actually fails because of this language in the treaty. So in order to override that, there is something called switchover. So some tax treaties may require a jurisdiction to exempt income from foreign permanent establishments. This exemption could block the IAR from applying low tax period. Okay, they don't have an option for foreign tax credit. They say it's always foreign tax credit and offset is fine. But here there is no option. And so they say, this would prevent IAR from application. So SOR prevents, allows the parent jurisdiction. So what is the solution? If you take a switchover rule, if the domestic IAR regulation has a switchover rule, the SOR allows the parent jurisdiction to switch from exemption method to credit method for PE income that is low tax. Okay, in such a scenario, you can pay IAR. It still becomes legal that you pay IAR. So without SOR, treaty requires exemption of PE income. So if that IAR is in respect of PE income, then it's exempt. It won't see the fruition of it. Now IAR cannot apply. Now with SOR, they will switch to credit method. IAR can apply. Foreign tax credit can be given for PE. So in such a way, IAR, the applicability is not of IAR is not blocked legally. Okay, did you understand switchover? Okay, okay, fantastic. So coordination mechanism. So there are few coordination mechanisms which prevents double taxation. You already know that. Okay, first thing is QDMTT offset. Whatever is paid by QDMTT would be offset before applying IAR and UTPR. Second is IAR offset. When both UP and POP pay IAR, the UP reduces its share by POP charge. We know that already. IAR offset. And UTPR residual only. Only the residual tax would be paid by UTPR. All this, all one, two, three, is to make sure that there is no double taxation. Okay. There won't be application of QDMTT and again IAR and it becomes a problem, right? So there is no double taxation. To prevent this is why these mechanisms apply. And also there is a UTPR carve. Now these rules you see is not just preventing double taxation, but it's preventing double non-taxation also. What is UTPR carve out? We discussed yesterday. If that particular entity, that constituent entity which is paying UTPR does not have a cash tax expense, then it is carved out from the group so that the pool, the 100% of the residual top-up taxes is divided between other constituent entities, excluding this one. So UTPR carve out mechanism 4 ensures double non-taxation also. Okay, so the 1, 2, 3 for avoiding double taxation and 4 for avoiding double non-taxation. Clear? Now filing and timing consideration. So this is the major thing. Like, since there are three rules in application, the filing and timing considerations are immense. So see, the local QDMTT returns depends on the jurisdictional ETR calculations. It is filed in QDMTT jurisdiction as per the local deadlines. Globe information return. So this basically, like, provides who is a low tax constituent entity or not. This is what is globe information return. We'll learn about it later. But QDMTT amounts from all jurisdictions. So filed in UP jurisdiction. So the thing is that first we need all the QDMTT returns to be filed by each constituent entity. Then only we can file globe income return. Then only we can apply IAR top-up tax return. Correct. IAR top-up tax return can be done only after GIR completion. And after all this is when UTPR local returns are filed. Now you understand the complexity here in terms of filing, because let's say, some country, let's say India follows April to March, whereas the globe income return has to be filed for January to December. So it is a little complicated, because since this is a sequence based system, the filing also takes in a sequence. So QDMTT returns has to be filed first, then GIR, then IAR, then UTPR. So that is why it will not be completed within 9 months. That's why there is an extension of 15 to 18 months for completing this. Okay. So it's really hard to coordinate, and if there is coordination challenges like timing mismatches, Hmm? They or UTPR filing timeline would be there. Within the UTPR filing timeline. If all this is not done, then we are facing penalties in that direction also. So coordination of this charging mechanism becomes really, really hard, really difficult from a practical point of view. Even though the law is very simple, the application of this law is very difficult. Did you understand that? So basically, today we discussed how they interact, okay, and the new concept that we learned is was switchover rule. So this is all about like the interaction of these three taxes. Tomorrow we'll take one more theory, like to understand the whole thing better, and then from next week, I think we will go ahead with the calculation of globe income and then top up taxes. So calculation it's of income itself is one whole week, and then taxes is another whole week. So stay tuned, but I hope it is clear till now. Charging mechanisms, a lion's share of that is over. So I hope it is clear what are the charging mechanisms included. You had no clue about this when we started on Tuesday, but see, it is only Thursday now. In 3 days, a lot of concepts were discussed: IIR, UTPR, QDMTT, switchover role, carve out. So please go back and read. It would help you in deepening and making these understanding complete. Okay, so let's wind up for today. We'll meet tomorrow.